So we got a lot to cover, and I'd like to refer you to our events webpage, provide background on our presenters, and we're going to have Brent Morrison of Morrison and Company begin.
All right, give me a minute. There we go.
Welcome, Brent.
Luis? So we're ready, we're good to go? Okay. Well, let's see if we can scroll on down here to the starting page. There we go. All right. Well, most of you, I'm guessing, have gone through the PPP program. Perhaps you've applied and got the award, or you did not. So what we're kind of going through here is going to start with going through the basics of the program, some new guidance that has recently come out, and some what we're calling tips and rumors. You know, when we talk to clients and others, I often start anything I have to say with this comes with an asterisk, because just as during the period of time when they were taking the applications, and it seems like things were changing on the requirements, and you'd hear this and you'd hear that, and then the rules would come out, or they wouldn't, or they change. Same thing is happening with the forgiveness piece of this. In fact, you know, Luis arranged for the four of us who are presenting today to do kind of a dry run Friday, which we did at 3 o'clock. And about an hour after we were done doing the dry run, the Small Business Administration sent out the PPP forgiveness application, which changed a number of the things that had previously been said or stated in SBA's FAQs, or just that had, you know, come out the rumor mill or best guesses based on what was known at the time. So I know a couple of us ended up going back and kind of redoing some of this over the weekend so that we could catch up with kind of the latest and greatest. So there's a little fewer asterisks in this presentation than it would have been you know, a few days ago, now that we have the PPP forgiveness application. I know a little later in the slides today, I think in one of Kate's slide, there will be the address for the link to that, and I think Luis may be able to get that out later so that you can get a copy of it if you have not gotten that already, or I'm sure you can contact any of the four of us who are presenting that could get that to you as well. So there's going to be fewer asterisks, but there's going to be a few things that are still up in the air. So if some of these things on the basics are things you already know, hang in with me, because some of these things have changed a little bit, and you know, just with the release of the forgiveness application, and some of them may continue to change as we go on. So the basics is, if you have your grant, the 8-week period starts when it's funded. Now, there has been some confusion because there's a statement in there that says through June 30th, but if your 8-week period goes past June 30th, you get the full 8-week period. The funding, or when they say when funded, that means when the cash hits your account, not when the loan was approved, because they had a 10-day window there from approving the loan to actually transferring the funds. So as soon as the funds hit your account, that's when your 8 weeks started. So the things that are eligible for forgiveness can be a little confusing, because in the application process, they listed a number of things that they said that the loan funds could be used for. And so the reasonable assumption would be that list would also be the things for which they would give forgiveness. That is not always the case in every item. And so that has caused some confusion, unfortunately, as well. So those two lists don't always line up. So I'm going to try to make the distinction as we go through this list. So the things that are eligible for forgiveness are cash compensation, which is going to be salaries, hourly wages, bonuses, paid time off, holiday time, anything for which an employee would typically be paid. State and local employer taxes on compensation. This does not count federal taxes. So the employer's portion of Social Security, for instance, is not included. That's not a forgivable expense. However, your state unemployment insurance, that is. So if there's any state or local taxes on compensation, those are eligible for forgiveness. Health benefits and pensions, retirement plans for the most part are allowed. Now, one of the things that has become clear is that for a while it appeared that the only interest that was eligible was interest on mortgages that were in place before February 15. In the application for forgiveness, they make it clear that it is interest on real or personal property. So if you have loans out for equipment or your office remodel or anything like that, as well as mortgage that could be considered real or personal property, that interest is eligible for forgiveness. Another thing that they clarified is on leases or rent. There was some confusion as to whether that was just on real property. So if you leased your building or your land, so on, that would be applicable. But what would other rent and lease expenses be eligible for forgiveness? And so they have clarified that too, so that rent and lease expenses on real or personal property. So if you're leasing farm equipment or production equipment or things like that, those would be eligible. In utilities, in the CARES Act, they have a specific definition of what considers utilities, and there's been some confusion over that, but I think the CARES Act is pretty precise on that. It lists electricity, gas, water, transportation, telephone, and internet access. Can you get by with anything else? Well, I think as long as you're upfront with your bank, because that's who the forgiveness application is going to go through, as to what you're including in utilities, you can try it, and then they'll say no if they don't think so. I've been asked. We have some clients that do a lot of processing that have have to have leftover materials, organic materials from processing has to be hauled off for garbage removal and things like that. Is that considered a utility? It's not specifically listed, but we're going to talk about the bank's role in this. You kind of want to make it clear for your bank. At least 75% of the loan forgiveness amount has to be attributed to payroll costs. Your forgiveness is going to be reduced proportionately if your full-time equivalents drop below one of two reference periods, or if you happen to be a seasonal employer, you can choose a third. So these reference periods are at your choice. So you can choose your FTEs between the time of February 15th, 2019 and June 30th, 2019, or January 1st and February 29th of this year, with the additional period for seasonal employees of February 15th, 2019 through June 30th of 2019. What constitutes a seasonal employee, or excuse me, a seasonal employer? Well, according to what it says in the Act, and I believe in the forgiveness application, it says that's determined by the administrator, which means SBA. So you would need to be able to make the case that you're seasonal. There is a reduction. There is kind of a safe harbor if you happen to reduce your full-time equivalents. If you drop down below, but if you restore them by June 30th this year, if you restore those back to the FTEs in your pay period that ended February 15th, 2020, it's a get out of jail free card. They will waive that reduction for that adjustment for a reduction in your FTEs. So the way it works then is amounts that are not forgiven are converted to a 2-year loan at 1% interest. There has been some confusion, but I think now some pretty good clarity with some of the frequently asked questions that the SBA released last week, that while the loan forgiveness itself does not create a taxable event, expenses that are forgiven are not deductible for your returns, which only makes sense. Otherwise, you'd be kind of double dipping on the deductibility. All applicants, when you applied, have had to do a good faith certification that the loan was necessary due to current economic uncertainty. If your loan was less than $2 million, it's assumed to be in good faith. If it's over $2 million, it's going to be based on, your individual circumstances. Okay, let me go to the next page. Oops, a little too fast. Okay, so some new things that came out and a few best guesses. One of the things that's been very confusing to people is that the documents, both for the application and the facts, have said that the expenses have to be both incurred and paid. That has been difficult. I would imagine for most people, the odds of your payroll period exactly lining up with your funding period, your covered period, are just about impossible. That's probably 1% of applicants. There is new guidance, though, now that you can select an alternative covered period for your payroll-related expenses. I won't go into a lot of detail. We have it up here on the slide, and it's explained in the guidance for the forgiveness application. But basically, you can take a period where, as long as you pay it within a certain period of time, even if it's after your covered period, you can take it on an accrued basis. For those of you that are accountants or have an accounting background, you'll know what I mean as far as on an accrued basis. That's actually incurred, but you do have to demonstrate that you actually paid it within a certain period of time. Let me see. What is an FTE? There has been some discussion on that. I think some of the best guidance I heard up until Friday was that it was 30 hours based on some language in the CARES Act. However, the forgiveness application refers to an FTE as 40 hours. That could have some implication as to what is most advantageous to you. That's another one where I would just make sure your bank is aware of what you're doing. But the forgiveness application does refer to an FTE as 40 hours. If your loan is over 2 million, they were at one time saying you're going to get an audit, then they changed that to a review. Then it's they're going to look at it. So, but you're going to get some kind of a review or audit if you have a loan over 2 million. So you want to make sure that you've got good, strong supporting documentations for why you thought the loan was necessary. So some of the things you might do is describe what you knew at the time of the loan, compare your volume, and however you measure your volume, whether it's sales dollars or units produced or whatever it has, compared to your staffing levels. And if you can show that you're maintaining staffing level even with declined volume, that will be a plus. One of the nice things that has come out recently too is that if you have a loan over $2 million and they find, if you have a loan under $2 million, they just assume that you did it in good faith. If you have a loan over $2 million, they're going to decide that. But if they decide that, no, that wasn't in good faith, you didn't have sufficient need for this, if you return it upon that finding, there will be no penalties. There was a lot of scary talk about penalties and jail time and felonies and all that stuff. That has been largely softened. All right, and then finally, if I can get the page to move here. Okay. Luis, I can't get my page to move. Nope. Let's go up. Tips and rumors. So here's a few things that we wanted to throw out, just some tips to keep in mind as you're going through this process. If you haven't strategized and sat down and planned out and done some math on as to how you're going to maximize your forgiveness, do it now. If you try to do it when the period's up or something like that, it's going to be very difficult. So I would do it right away. If your loan is over 2 million, we've helped some clients, even if it was a little bit after the fact, go through and do projections based on what they knew at the time of the application. Do that and document every reason that you had for applying for it. If you are a privately owned company that has ownership, we advise against making any kind of distributions to your owners during the covered period. That is not the same as regularly scheduled, for example, revolvement or retains for co-ops and things. Those are fine if they're within reason and within your previous policies. But as far as a privately owned company, this is not a good time to be paying bonuses or distributions to your ownership. Loan recipients shouldn't be making intercompany loans to their related party companies at this time unless it's something that's wholly owned. Again, that's not a stated rule. We just think it's good advice. You do get a waiver if you offer somebody a chance to come back to work and they decline. They don't count that against your FTE count. They have given no guideline as to how to document that, but I would say write notes, document the conversation. I offered it on such and such a date, they declined, and make sure that you have that ready. Contractors and 1099 labor, there has been some clarification on that. They do not count as employees. That would be double dipping because 1099 laborers and contractors could apply for this on their own. Be in touch with your bank if you haven't been and talk through them. Any question, the bank is going to kind of be on the first line of defense in these things. You're going to file the application for loan forgiveness with them. They're going to review it. They're going to run it by the present it to SBA. So they're kind of on the first line of defense. Some of them are a little edgy about that, but be in touch with them on the critical points. A few kind of rumor things that we've heard. Hard to say how reliable any of these, but let's just say I've heard these enough from enough sources that I thought it was at least throwing it out there. One is that the 8-week covered period may be extended. The asterisk there is that would take an act of Congress because it's in the CARES Act. It has been discussed. I don't know that there's been any action. The 75-25 rule on having at least 75% of forgiveness related compensation may or may not be waived. It's again been talked about, maybe waived or extended to 12 weeks or 16 weeks. And there are some different views as to whether interest other than on real and personal property is forgivable. That probably wouldn't apply to a whole lot of applicants. So that's what I got on what we know about the PPP loan forgiveness updated for what's in the forgiveness application that came out Friday.
Hello, everybody. I'm Eric Kreinert with Moss Adams, and what I thought I would do here is just give you a high-level kind of walkthrough about how this forgiveness computation works. So I thought I would run through just a couple of quick examples here and how this forgiveness works. And so I'm going to make the assumption that the borrower received a $1 million loan from the SBA, and that loan was originated on the 24th of April, so that would be the start of their 8-week clock. Further, going to assume that this particular company perfectly timed all their payroll and expenses to have all their expenditures during this 8-week period to exactly equal their $1 million. And so I've basically said we've got $750,000 worth of payroll costs, and I broke that between cash payroll of $600, health insurance and other health benefits of $130, and retirement payments of $20 to get our $750. I am also going to assume for now that everybody is earning less than $100,000 just to make this walkthrough easier for us. There we are. And everybody was working inside the United States. There are adjustments needed for all of those things. One thing to keep in mind is the max that you can pay any one employee during this 8-week period is $13,385. Anything above that is annualized at more than $100,000, and so you're not able to include that amount over that $13,385. We've also picked up some non-payroll costs, interest on mortgage obligations at $30,000, rent at $150,000, and payments on utilities at $70,000. So we got a total of $250 of other expenses that are qualified. And so our total costs of qualified expenses are $750,000 payroll, $250 of non-payroll, We've met all the criteria of the various different ratios, and so we're going to get 100% of our loan forgiven. It seems pretty simple, but it gets a lot more complicated if you don't hit these things precisely. So just showing you, if instead of $750,000, we only had $700,000 of payroll during that 8-week period. And we can see that our forgiveness drops down to $933,333 just by a $50,000 reduction in payroll. So we reduced our payroll by $50,000. Our reduction was $67,000, and so we end up with more of a reduction because of the requirement that we have to have 75% of our forgiveness related to payroll. So each dollar of payroll that we pay will get us an extra 33 cents of rent, utilities, and mortgage interest that we can get forgiven. We use the same example and we just bump up our utilities to $100,000. We can see that we've had a lot more going out the door, but it really doesn't change our forgiveness because, again, we're limited at that 75%. And so one of the things that I've been stressing to my clients to do is to really figure out how much you're going to spend on your mortgage obligations, your rent, and your utility payments over this 8-week period of time, and figure out what that is as best you can. And divide that by 75%, or excuse me, by 25%, and then multiply it times 75 cents or 75%. And that will give you the payroll that you need to spend in order to maximize your forgiveness on your other amounts. Keep in mind that your max amount is also subject to 25% of your loan facility, so that will also be an upper limit for those other expenses. But if you have at least that 25% of your loan amount in these other categories, and your payroll is less than that maximum, you know that any dollar you spend on payroll, whether that is regular cash compensation, health insurance, or retirement payments, will increase the amount of your forgiveness, and it will increase it more than dollar for dollar. So you spend $1 on payroll, you get 33 cents of extra forgiveness on your rent, utilities, and mortgage. If this is cash compensation, one of the things you need to keep in mind is that you will have to pay payroll taxes, and that's Social Security, Medicare, federal unemployment, workers' comp, those types of things. And so you're probably, and those amounts are not eligible for forgiveness. And so as an employer, you know that each dollar of payroll is got at least 8 cents on it related to those other payroll taxes that won't be forgiven. So keep that in mind as well.
Hey,
Lastly,
Eric,
yes.
could you please zoom in on the spreadsheet? Folks are having a hard time seeing it.
Well, that is a good request.
Thank you.
I think if you go on view, you should be able to zoom in. Oh, there you go. Yeah.
We about there?
I can see it just fine, Eric.
Okay, good. The other adjustment that needs to happen is if your full-time equivalents, like Brent described, decrease during this 8-week period of time, you're going to get an overall reduction in your forgiveness amount. And so for purposes of just kind of moving through this quickly, I said that we had 80 employees, and we had 80 employees in the 2 reference period. But if the reality is we actually had 90 and 95, we're going to see that we're going to get a reduction of a little bit over 11%, and so our baseline forgiveness of 933 quickly changed to 829,000. That is a dramatic difference that everybody needs to pay special attention to. The safe harbor here is that if we hire full-time equivalents back before 6:30, that we do not have to go through this thing. So one of the other things that you want to do early on in this process is figure out what your full-time equivalent is in each of these 2 reference periods. And if you don't think you're going to get to a full-time equivalent during this 8-week period, start figuring out plans on how you can hire folks back before 6:30, and then you don't have to do this computation at all. So if we just meet that safe harbor and we get everybody back on the payroll as the right amount of full-time equivalents by 6:30, we can change this to a yes. And even though during that 8-week period we were below, we don't have to go through this adjustment here. So key and critical thing to consider. There's also, I think Brent alluded to it, that if somebody, you offered somebody a job back, but they declined because they got another job or they think unemployment is better, if you document that, you don't have to include those people in your adjustment here. And I think really what that does is I think it reduces the count in each of your 2 reference periods. So if we were at 89 before, or excuse me, 90 before, and you had 2 people that you had offered positions to, but they didn't take them back, I think what that does is reduces your reference periods down to 89 and 93 respectively. Similar things are available if you fire somebody for a cause, or somebody voluntarily leaves or voluntarily takes a decrease in hours and goes from full-time to part-time. And I think there's going to be people in that situation, especially because childcare has been extremely difficult over this period of time. And so that we might see, a lot of those types of things. So they did offer a little bit of flexibility there that you don't have to include those adjustments in your computation. So Luis, if we could minimize this one and go to the other PDF spreadsheet. Perfect. Okay, this is the application that the SBA released on Friday afternoon that Brent was referring to. The first 2 pages are some instructions and general definition. Here's where they define this alternative payroll period, and basically you can start your alternative payroll covered period on the first payroll after your loan disbursement. I think there's some planning opportunities here. So if you had some folks laid off and then you got them back, you might want to do this because you're going to have more payroll if you delay this thing by a few days, half a week, etc. That is eligible for forgiveness. The other thing that this is going to do is just make the overall computations easier. And so by making this election, I think it's going to be so much easier to figure out your payroll and your various different FTE calculations and other things. And so, if it's, I'm recommending it for that reason, but there may be some planning reasons that you don't want to do it too. So just be flexible and work through different scenarios there. Get to the actual application itself. Basic borrower information at the top part. You're going to have to enter your loan number, your loan amount, disbursement date. If you got an EIDL loan and grant, you got to put those information on there. You got to put information about your payroll and what your actual dates of your COVID period are, and if your alternative payroll, if you're going to use that. And then here's this infamous $2 million checkbox, and it includes any potential affiliates. And so you're going to check that, and that is your please come audit me checkbox, but we will see what that actually means, but that's their plan. And then we're going to enter the basic payroll, mortgage interest, lease, etc. And this thing is once you read through it, it's really easy to, better to start at the back end. And so I'm going to do that here. So the actual application is very simple and total of 11 lines. But the devil's in the details, obviously. And one of the things we're going to have to do is really list out all of our employees individually. And we're going to do that through this worksheet A, Schedule A worksheet, excuse me, I'm going to say it right. So table 1, we list the employee, their identifying number, the amount of cash compensation that we paid during either our covered period or our alternative covered period, the average FTE that particular employee worked during that period of time, and then any salary reduction. And I didn't talk about this on the other slide. So basically, if we have any employee where their salary or their hourly wage, if they're not on salary, reduced by more than 25% during this covered period in relationship to the base period, which is January 1st through February 29th, then we have to go through an adjustment. Most of the adjustments and things I've seen here, most employers are not reducing people salary or wages by more than 25%. This only applies to employees that were earning less than $100,000 for all of 19, and it even defines it as any payroll during 19 on an annualized basis. So it's quite possible that somebody got a bonus in 19 during one of their pay cycles that would have put them over $100,000 on an annualized basis. So while we have to go through the math here on this adjustment, I don't think it's going to be a major adjustment. The second table is essentially the same, but it would include anybody who is over that $100,000, and then you don't have to go through the salary reduction component there. You take all of those things and you roll them up then to Schedule A. And this is where you will go through your computations and calculate your full-time equivalents, which is basically just a total of those things that are on the worksheet A. And ultimately, this drives us to our payroll numbers and our full-time equivalent adjustments, which then pull into page 1. Keeping this pretty high level to keep things moving. I notice we're a little bit beyond past time, and so with that, Luis, can you turn this over to Sean to move on to the next section?
What I'm going to cover here just for a few minutes, and I won't belabor this too much, and be happy to take questions later on, as Eric was saying, just to be respectful of everyone's time. Want to just take a couple slides and cover kind of the leave portion, the HR portion of all this. The Families First Corona Response Act, this has been out for a little bit now. It started April 1st. A lot of hype surrounding it for the weeks before it actually was enacted on April 1st. But it's essentially two portions. One is a paid sick leave, and then the other is expanded family medical leave. The paid sick leave is 80 hours of leave related to an employee's own COVID-19 related health condition. This is paid at 100% of the employee wages, up to $511 per day. So if someone has their own personal related COVID-19 type situation, whether they're experiencing symptoms, they come down with the illness, anything related to their personal situation and caring for themselves, they're entitled to 80 hours of paid leave at 100% pay, of course capped at $511 per day. The second portion of this is related to not an individual's personal health condition related to COVID-19, but if they need to care for another person or provide child care, if a child care facility or if the child's school is closed. This is paid at 2/3 of the employee's wages and up to $200 a day. And you notice that 200 is not 2/3 of 511. That was intentional in order to motivate folks to not take advantage of this too much. But so that's 2/3 pay, up to $200 a day. The other segment of this is expanded family medical leave. This would kick in after the 80 hours above and is only related to providing leave to care for a child. It is not for personal situations. It's not for the open-ended caring for another person portion. This is only focused on providing child care. This would be a total of 10 weeks paid at 2/3 wages, again, up to $200 a day. So the expanded FMLA could kick in directly after the 80 hours for a total of 12 weeks of paid leave at 2/3 wages. And these wages are refundable through a federal employment tax credit, which we can talk about the details of that a little bit later. Maybe the tax guys would be happy to take that one, but it is refunded 100% through federal employment tax credit. So the second portion of this, and I'm not able to advance the slide here, Luis, if you could go ahead and go to the next one. The second portion relates specifically to California. Thank you. There you go. For our California employers, on April 16th, there was some additional legislation. Actually, it was an executive order that came out that essentially expanded this to employees who work for companies that employ more than 500 people nationwide. So the provisions we were talking about earlier were all for smaller mid-sized companies. So up until April 16th, this 80 hours of paid sick leave, 80 hours of FMLA, and then the 10 weeks of expanded FMLA, that was only for employers that had less than 500 employees. So California enacted this executive order to kind of fill what they called filling in the gap for large employers. So if an employee works for a company that employs employs 500 or more people nationwide, that employee is covered if they are some type of a food in some type of food chain. So it's basically from a farm worker all the way to retail food supply chain. And this is 80 hours of paid leave for qualified employees at 100% of wages, up to $511 a day. And a qualified employee is subject to a quarantine order or someone advised by a healthcare provider to self-quarantine, or an employer prohibits. Sorry, I've got a pop-up that is blocking my screen and I can't read that. But by memory, I can remember that it's any type of situation where an employer is going to prohibit an employee from being at work due to transmission concerns. So there's the two pieces of this. Is one of the nationwide sick leave and expanded FMLA, and then this specific California executive order. So I will be happy to take some specific questions on that later on. So Luis, I'll let you go ahead and advance it to the next person.
Luis, can you hear me?
Yes.
Okay, good. So I just want a couple of other points to keep in mind that came out with part of the CARES Act. First is all employers are able to defer the Social Security part of their payroll taxes that are incurred between when this law was enacted, which was right at the end of March. I think it was the 26th or 27th, all the way through December 31st. The language in the bill said you couldn't do the PPP loan and the Social Security deferral. The IRS has issued guidance on this, and basically they're allowing payroll tax deferral up until you get your forgiveness letter from the bank. And so at best, we're probably 60 days from that letter from the bank, if not more. So I would highly encourage anybody that has any amount of cash issues or loan outstanding to take advantage of this and contact their payroll provider, or do what you need to do on your own self-prepared payroll. But any amount not paid during this period of time automatically converts to an interest-free loan from the government. Half of it's due at the end of December 2021, and the other half is due at the end of December 2022. So again, highly encourage people to take advantage of that. Other things that are out there, if you didn't get the PPP loan, you get the employee retention credit, and that is 50% of any payroll up to $10,000, so $5,000 per employee. Healthcare costs do get included towards that $10,000 limit. And if you're less than 100 employees, If you are in a quarantine area, you're going to be able to get forgiveness. If you're more than 100, or you're going to be able to get that credit, excuse me. If you're more than 100 employees, then it's just the employees who are not able to work for whatever reason or telecommute that you would get the credit on. Sean just talked about the family leave and sick pay. The other things that are out there that don't have any connection at all to the PPP. If you had net operating losses in 2018, 2019, or 2020, you can carry those losses back 5 years. There is the ability, they did change the law as it relates to qualified improvement property, and that's now eligible for bonus depreciation, which is 100% depreciation in the year that you place it in service, and that applies retroactively back to 2018. So we're highly encouraging everybody to go back and look at their old returns, see if there's a loss on there or the ability to generate a loss to carry those back. Remember, 5 years ago were old tax rates, and they're generally higher than current tax rates. So any amount that you can carry back is going to be beneficial. And the other thing that changed is the interest expense limitation. Previously, we were at 30% of adjusted income. They changed that to be 50% of adjusted income for 2019 and 20. So you have some increased interest that you can take deductions on. And then lastly, I wanted to clarify, as I was going through the spreadsheet, I think I said payroll of 13,000 something for that 8-week period. It's actually $15,385 during that 8-week period. So apologize for the slip up there. Luis, please move it forward, and I think we're on to KDEEP as next presenter.
If I could ask Eric, we've already gotten a few questions about the accessibility of the spreadsheet that you used to demonstrate. Is that accessible?
It is not. We are doing engagements with our clients, including new clients, to kind of work through planning with that spreadsheet. However, we're not releasing it to the public because, as Brent alluded to and I've alluded to, this law and guidance has changed literally daily or weekly, and we just don't want the liability that goes with having a spreadsheet out there. And so until this thing gets more nailed down, I don't think we'll be releasing the spreadsheet, but we will be working with clients individually on it.
Thank you. I have got KDEEP unmuted, and I believe that we have KDEEP on video now.
Yeah, good afternoon, everyone.
Excellent.
I'm assuming you can hear me, Luis.
Yes, very well.
Okay, great. Thank you, everyone. My name is KDEEP Dhaliwal. I'm also a partner with Moss Adams in our Sacramento Stockton offices. Happy to be here with you folks today. I'm going to cover at a very high level some of the alternative financing that's come out of the pandemic that we're all in right now. This is really the response from the National Treasury and the SBA on some other financing options outside of the PPP loans that we've covered today. So Luis, let's see if we can move it on 2 slides.
Sure, I have transferred control to you, but it's been spotty. Its effectiveness. Could you try?
Let's see. Yeah, not working for me. So maybe I'll just let you know when to go on to the next slide. You could skip one more. Okay, perfect. So the first one of these alternative financing options that are out there is one of them is the Main Street Lending Program. Now, this is administered by the U.S. Treasury, but applying for these loans and getting these loans really will go through your local bank. So this is something you'll want to talk to your local banker with if it's something of interest for you. The Main Street Lending Program, what this is about north of $600 billion that is intended to facilitate lending to small and medium-sized businesses, not an SBA program. Seems to be working more like conventional financing with some slightly eased underwriting policies. How this one will work, the Federal Reserve will underwrite and maintain 95% of these loans. and a smaller portion of the remaining loan balance will be held by the local lender or the eligible lender. And really, like I said, this will be going through your local bank. So any US FDIC approved lenders should have access to this program. The borrowers, this is really intended for companies with businesses up to 15,000 employees or revenues up to $5 billion. So a very broad set of companies would qualify for this program. And there's 3 types of loans under the Main Street Lending Program. One is referred to the New Loans Program. The second is the Priority Loans Program, and then the Expanded Loan Program. And the terms are generally very similar between the 3. So it's a 4-year term. The principal and interest for the first year will be deferred. The interest rate is prime plus 300 basis points, so prime plus 3%. And there are certain limitations on this loan. It really refrains from how you're going to use these loans to pay off any other type of financing that's out there, as well as some restrictions on compensation and distributions. So Luis, next slide. This table does a nice job of breaking out the terms of the 3 programs I mentioned. As you can see, the loan term for all 3 is 4 years. The new loan and the priority loan has a minimum loan size of $500,000. And then the expanded loan facility has a minimum loan size of $10 million, so a much larger loan facility. There are ceilings to these loans, so the maximum loan amount under the new loan and the priority loan program is going to be the lesser of $25 million, or you take your amount and add it to any outstanding existing debt that's out there, and that amount can't exceed 4 times EBITDA, and then 6 times EBITDA for the priority loans program. And then for the expanded loans program, like I said, this is a much larger tranche of loans. The maximum loan size there can go up to $200 million, or the lesser of 35% of existing debt, multiplied by 6 times EBITDA. So the risk retention, why this would be favorable to your bankers is because they're not participating in a significant portion of the risk. It is backed by the US Treasury. So under the new loans program, the lender will only retain 5%. The priority loan program, the lender retains 15%, and then 5% under the expanded loans program. Payment terms are slightly different for each of these. So under the new loans program, in years 2 to 4, you pay those off 33% each year. Under the priority loans program, it's a slightly graduated scale, where under year 2, you'd pay back 15%, year 3, 15%, and year 4, 70%, the remaining 70%. And that's very similar for the expanded loan program. Next slide, Luis. So similar to the PPP program, there are certain certifications that the borrower will need to make in order to qualify for these loans. It's really not intended to refinance existing debt that's out there. So some of the terms here will prohibit you from repaying principal balance on or interest on any other loans unless that is mandatory loan payments. You're not supposed to use these loans to, reduce other committed lines of credit. So it's really an additive loan program on top of what's already out there that you have borrowed. The borrower has to certify that you're going to be in business for at least the next 90 days and no plans to file for bankruptcy. There's certain restrictions as to how you can use the funds. So you've got to follow compensation and stock repurchase and capital distribution restrictions that apply to these programs under the CARES Act. But S corporations have a little more latitude where you can use these funds to make distributions to cover your owner's tax obligations. And there's certain conflict of interest that you will need to certify that is prohibited under the CARES Act as well. Next slide, Luis. So some common frequently asked questions on the Main Street program is how will EBITDA be calculated? It's no different than under a normal circumstance, how your current lender would be calculating EBITDA. If you do have other debt that's out there, this debt will need to be senior to other debt for the new loan program, for the priority loan program and the expanded loan program. It can be simultaneous or step-by-step with your existing debt or senior to existing debt. It all depends on the terms that you enter into. The program as of today is effective through September 30th, unless it's otherwise extended. I wouldn't be surprised if they extend it further than that. Question could be that, can you take this loan along with some of the other loans? There's no restrictions with respect to the PPP loan. So if you did take the PPP loan, you can still qualify for the Main Street programs. But if you've taken some of the other loan programs under what's called the primary market corporate credit facility, in that case, you would not be able to take advantage of the new loan programs. These could be secured or unsecured borrowings, and the fees are generally between 75 and 100 basis points, depending on the program you enter into. Next slide, Luis. I mentioned there's certain restrictions on your annual revenues and employees. Annual revenue is really just backward looking, so fiscal 19's annual revenue. And for your employee count, you've got to factor in all of your part-time, full-time, seasonal employees, but you can exclude independent contractors. And you would generally be using an average of total number of employees during the last 12-month period. I suspect if somebody is eligible for this, for the folks on the call, you probably don't have more than 15,000 employees, so you should be fine there. We talked about outstanding debt and other outstanding debt, kind of helping to figure out what your maximum borrowing capacity could be. And how that's defined is really all amounts borrowed, including unsecured or secured from any bank or private lenders. Basically, any kind of existing financing you have will need to be factored into what the new amount could be under these loans. And I mentioned, there's certain compensation and stock repurchase restrictions for S Corps and other tax pass-through entities where you're allowed to make distributions to cover owner tax obligations. You'll still be able to do that, but you're going to have to agree to not pay any dividends or make any other capital distributions with respect to common stock for at least 12 months. And the other frequently asked question is, do I need to maintain employee levels consistent with the CARES Act, similar to what's happening with the PPP loan? What we know right now is that borrowers must make a reasonable effort to maintain their payroll and retain employees during the outstanding portion, but we're still waiting on some guidance as to the exact compensation levels there. Next slide, Luis. So where we stand today, as of last week, this program was still not live. I haven't heard anything as of today either. The Federal Reserve is still working on putting the infrastructure in place. I think a lot of the bankers have been quite bogged down with the PPP program. So over the next couple of weeks, I would think we're going to have a little more idea of when these will go live. The Federal Reserve and the Treasury continue to solicit some feedback, and there are some ambiguities that will need to be cleared up with these loans. Next slide, Luis. So my last two slides are going to cover the economic injury disaster loans, better known as the EIDL loan. This is a program by the SBA, and you would apply for this directly through the SBA. What this loan is rather favorable terms. It's guaranteed by the SBA. Loan amounts up to $2 million for 30 years. Just as of last week, it appears that the SBA has limited this borrowing now down to $150,000 maximum. There was just a ton of applications that came in. And so they've slowed the processing on these. So where it was up to 2 million, now it's up to only 150,000. And they're only taking applications from farmers and farming entities right now until further notice. The principal and interest will be deferred for up to a year on the EIDL loan. And there are some reduced requirements. You know, in some cases, you don't need a personal guarantee if your loan is less than $200,000. Certain entities will be limited as to their ability to take these. So churches, cannabis industry, other small businesses as described by the SBA. And really the intent for the EIDL loan is to provide working capital for companies that have been injured through this situation. Last slide, Luis. Finally, the economic injury disaster advance. It's called a loan, but as of the way we understand it, this does not necessarily need to be paid back. It's a $10,000 advance to provide immediate liquidity for companies that may need it. These funds can be available within 3 days. Again, as of today, only ag entities are able to apply for this advance. And again, the eligibility is for all small businesses as defined by the SBA. So with that, I believe we're done, and I'll hand it back to Luis to cover the questions, or at least facilitate that.
Luis, it looks like we're about 25 minutes behind schedule here. So if you want to open up all of our presenter mics and videos, maybe we could just start rolling through these questions and getting them answered and see what others type in the meantime.
I have unmuted everybody, and I will go ahead and also put on video.
Why don't you move the slide ahead to our contact information, just in case anybody wants to contact us individually.
Oh, let's see, yes.
I got one that was on the queue here. I'll go ahead and it was related to the EIDL loans grants. And so anybody that did get their EIDL application in earlier was eligible for a grant. That grant was up to $10,000, and I think they limited it to 1,000 employees. And so if you got one of those grants, it would have shown up as a direct deposit into your checking account. When your loan does get forgiven, the SBA will subtract the amount of that grant from the total amount that you have forgiven. So the example that we had on our spreadsheet, I think the forgiveness amount was $9,333,333. You subtract 10 grand from that if you got the advance, and you get 923,333 as your forgiveness amount.
We had some questions come in before during registration, and some of these were quite good. One is, so for some co-ops, they are organized as limited liability companies. Are limited liability company partnership owner distributions eligible for forgiveness? These are our monthly salaries paid from our capital accounts.
The short answer is yes, there is guidance for self-employed people, including partners in a partnership. It is limited to that $100,000, and it is based entirely on what your 2019 income was. And so if you do fall into that situation, I do encourage you to go to the SBA's website and download that guidance and read it, but it is there. You don't actually, I don't think you really need to make the payments for those individuals. You just have, because it's all based on the 2019 income that was allocated to them.
Excellent. And to reiterate, does 401k accrual count towards payroll costs?
Short answer is yes. I am very confident that you will get a benefit associated with 8 weeks of payroll, including retirement. Because they wrote the language so clumsily, it appears as though you can get a a 401k contribution paid by the employer as an example that was related to 2019. If you happen to pay it during this 8-week period of time, I wouldn't really plan on that though, because I suspect we'll get further guidance that will take that benefit away or clarify the way they wrote the language. So, you know, put it in a separate bucket. That would be nice, but don't plan on it just in case it gets taken away. And then the accrual also works that if your payroll, you know, ends on a Friday and you make your 401k contribution, you know, the next Friday, the way they wrote the rules on that application does allow you to get that that payment next Friday is qualified for purposes of forgiveness.
Okay. Is it confirmed that we can have up to 20% in FTE reduction from pre-PPP and the reporting period after? I think confirmation of that?
No, I don't. I'm not sure exactly what that's saying, but any drop in FTEs will potentially reduce pro rata your forgiveness amount, unless you get that FTE count back up to where it was in one of those reference periods by June 30th.
Okay.
So if they want to clarify that question, I'm happy to address it, but as it's written, I'm not aware of a 20% FTE reduction. Brent, you?
No, I'm not either.
Okay.
And I think panelists, you're seeing questions on the question and answer page, correct?
Yes.
Are there any from other speakers that you see that you'd like to answer?
Just go through them.
Sure.
So the first one says, I didn't get PPP until 5/11. Meanwhile, I had 2 months of no work prior to that, but I can only apply the PPP to 8 weeks after 5/11. Is there any provision for the 8 weeks prior to 5/11 that had no income and couldn't get unemployment either, since I am self-employed? So since you're self-employed, your forgiveness amount is, the wage part of your forgiveness amount is tied to your 2019 income. So you'll look to your Schedule F or your Schedule C in 2019, take that income divided by, boy, what are they doing? Divided by 52 times 8, and that's essentially what you're going to be eligible for. And then you also get to add on to that your mortgage, your interest, and your utilities, just like anybody else would.
Next question about if you could address how the SBA is defining owner-employee on the forgiveness application.
That is an open question because they seem to imply that there's a different standard for owner-employees. I think they were referring to self-employed people who file a Schedule F or a Schedule C, or possibly a partner in a partnership or a member in an LLC. But the way it's written on that application, I think if you are an owner in an S Corp or an owner in a C Corp, I think you might fall into that definition, which so far we don't have any real guidance there. So my gut is that it's limited to self-employed people, but we shall see as we get more further guidance.
Yeah, and Eric, I have the same take. So if you are an owner of an S Corp or something like that, and you're on the payroll, I think your payroll was included.
If we've had an employee-initiated termination, is that a drop in FTE considered? That means they quit.
Brent, go ahead.
So my understanding is if they quit, and you're not able to backfill that position, but if they quit, you didn't let them go, they were allowed to keep their job. It was offered to them that it does not reduce your, you don't get the penalty for that. Eric?
Yeah, that's correct. So I like I said, I think it just adjusts your base period. So in our example there, we were using a base period of 90 employees. If one of those says they don't want to come back, then I think your base period just kind of gets adjusted down to 89 and makes the computation based on that.
Regarding group benefit expenses, is that the employer portion of the premiums, not the employee portion?
That's correct. That was clarified in these instructions. So you don't get to count, the employer does not get to count anything that the employee is paying for.
What does transportation costs include? Would it include freight costs we pay to transport our products?
We don't know. All of us are surprised that anybody defined utilities to include transportation, but leave it to Congress. That being said, we did get one piece of guidance from the SBA that said transportation included gasoline for your vehicles. But to take the step towards delivering your packages, I think that's a step too far personally. So I wouldn't plan on that. But you know, if you've got it, it's easy to track. It might be worthwhile tracking, and then we'll see what further guidance says.
Let's see. Can the 75% minimum requirement for payroll expenses include group health benefits and employer portion of retirement benefits?
Yes.
How
No, I
is,
think that's clear.
anything additional comments?
No, I think that's clear.
And how is FTE calculation performed? Is it hours worked for the calendar month divided by weeks and month divided by 40 hours? If not, how should we calculate it?
It's over the weeks. So that's a little awkward because, you know, often, particularly if you talk about when you close your books and what have you, it's usually at the end of the month. But no, they make it over the 8-week period. So you have to take a look at what's worked and what's paid over those 8 weeks.
Yeah, this is where using that alternative covered period is going to be helpful, so that your payroll period aligns and you don't have to do any weird algebra. So that's one reason to use that. They did give you the election that anybody working less than 40 hours a week, you could just call them half time or 0.5. Otherwise, you take hours worked divided by 40 and round to the nearest tenth. And so that 0.5 may, you know, there may be some planning opportunities for people that have a lot of part-timers, but I think it's just there for conveniencies. So use it at your will.
Prior to the guidance that came out on the alternative payroll period, and Eric, I don't know about you, but I hadn't even, our alternative covered period, I hadn't even heard that suggested, you know, at least not phrased that way up until that came out. Prior to that, I can tell you that we were advising clients, if there was a significant difference, to do an extra payroll period, you know, right as of the last day of the 8-week period. So I spent the weekend and this morning emailing my clients that I had told that, never mind, you know, you don't have to do that. You can essentially do it on an accrual basis.
Yeah, I like to say we don't have to do as much financial gymnastics now.
Yeah.
How do we qualify as seasonal employers, and how does this help with the FTE issue? And this is from a seasonal farm.
Well, my understanding, Eric, and step in here if you have more on this than I do, but my understanding is that whether or not you're a seasonal employer is kind of determined by or approved by, they use the phrase administrator, but basically what that means is by SBA. I have not seen any specific definition or criteria or benchmarks to meet to be considered a seasonal employer. So this is one of those where I'd probably run it by your bank first. And, you know, if you're a farming operation, for example, most row crops here in Northern California are going to be seasonal. And with some exceptions, a lot of farming is that way. So you can probably make the argument, but I'm not aware of any hard and fast criteria on that.
There was some guidance that came out, and it's on the SBA's website, and I am not for certain what the exact criteria is, other than I do know that when we're talking about those base periods that we were talking about before, seasonal employers are able to pick any 12 consecutive week period that I believe starts May 1st and runs all the way through September of 2019 to kind of figure out what their base period is. Otherwise, you know, that's going to be very specific. And so I would encourage people to read that and or connect with an advisor who has spent some time considering those issues.
The guidelines, so this goes out to the application that you reviewed, Eric. According to question 16, the guidelines, let's see, they allow payroll to be accounted for based on gross and can also include state taxes. Basically, gross, said differently, hours worked times dollar per hour. For example, $15 times 40 equals 600. Is that correct? I hope that question is intelligible as it's written.
Yes, that is correct. And early on, there was lots of, do we have to subtract for this and add for that? So it did get clarified 3, maybe 4 weeks ago. So this, you know, simple example is somebody's making $15 an hour and works 40 hours a week. Their gross pay that you're doing all this stuff is $600 for that week.
And then you would add to that, you could also take any state or local employment taxes, such as your unemployment insurance on top of that. Anything that's out of if it's out of the employer's pocket and not counting the, you know, federal contributions like Social Security and what have you.
If I give an employee a bonus in my 8-week period, can this be forgiven?
Yes, up to that $15,385. So you got to look at what you're paying in cash compensation during this 8-week period and make sure that the bonus doesn't kick them above that amount. Otherwise, you're only going to get forgiven up to that $15,385. The other thing to keep in mind is that any cash compensation you're paying is going to cost you payroll taxes. So make sure you've got enough rent and utilities and mortgage interest to get some benefit for paying that extra. Otherwise, you're going to be, you know, roughly 8% in the hole by paying extra during this period of time.
And I would say, especially if you're going to, if you're going to get an audit, if you're in that $2 million loan or higher, kind of as we were talking earlier, I would not bonus out management. No, I don't mean your superintendent or something like that, but I mean as far as, you know, executive level management or ownership, I would not pay any bonuses, and by the same token, I wouldn't make any distributions just because of the way it looks. You know, I'll tell you a story that someone told me that they have a client that got a $7 million loan, which is on the high side. I mean, they're just, I bet you it's a fraction of a % of applicants got a loan that high. And they had determined they were going to make an $8 million distribution to owners during that period. And this fellow advised them strongly, don't do that. Doesn't look good. You know, they did it anyway. So, you know, I hope I hear back how their audit goes.
So we're getting close to the end. I don't think we're going to be able to answer all the remaining questions that have still been coming in. And I did want to get back to one of the questions that came in during registration. And it comes from a nonprofit that also has grant funding, including federal. And this is going to be a question, I bet, for Brent. Let's see. We can cover part of our payroll related costs. So grant funding covers part of the payroll. And we also received an EIDL advance. We understand that we must not double dip and want to make sure that our documentation and requests for forgiveness is done properly. On our federal grant, we also have a cash match portion, and we'd like to know how that is affected and should be accounted for in the EIDL program.
Okay, so I can make one comment, but I'm less familiar with the EIDL program, and that may be one more for Kadeep or Eric. But you know, we work a lot with one of our service lines. We work a lot with grants, and you know, with the cash match, you know, one, they're not going to make you let you double dip if your match is in the form of payment of salaries and wages. I would imagine that would count because that's out of pocket as opposed to, you know, something that's being reimbursed by the grant. But I will tell you that's just an educated guess.
Thank you. You mentioned farms and ag businesses are not being considered. As an ag processor, do you think we'll get a re-examination?
Ag right now is the only thing being considered for the EIDL loan, because everybody else, the SBA had was convinced early on in the process that ag entities were not qualified, and then Congress re-upped the limitations. They made it clear that ag companies were qualified, and so this quote unquote second round of EIDLs is more or less just open to ag companies as a result of the mess up of the first round. What was the second part of that question?
Do you think we'll get a re-examination?
Like an audit, or?
That's all that's written.
Not sure there.
Yeah.
And Katie, there was a question for you. Did you answer that offline?
There was a question about prepayment penalties, I believe, on the Main Street loan, and I answered no, there are no prepayment penalties under those loans. There was also, I think by me clicking it, it made it disappear, but it was a good question from George about, can you use the Main Street loan if you're going to pay off or make patronage dividends to cooperatives? Really good question. I haven't seen anything in the terms that would indicate that patronage dividends to cooperatives are prohibited under this. Really explicitly talks about distributions relative to common stock for 12 months are excluded. And co-ops are eligible for the Main Street loan program, but I'm not sure how they're going to interpret patronage dividends.
I'm going to bet money they're not going to spend time thinking about co-ops and when they're writing rules.
Probably right. I'm surprised they included them in there, but it would be very, non-conducive to continuing business for the cooperative if they were then to limit distributions for patrons. So I would not expect that to happen.
Yeah. Thing to keep in mind is patronage dividends are more in the form of rebates than they are actual stock dividends, and so there should be some clear logic to make a differentiation there. It's just a matter of if anybody's going to spend time thinking about it.
Did you say that payroll expenses do not include workers' comp, or they do?
I don't think they do. We don't have any specific guidance on that. I think worker comp is insurance. I do understand that Washington State has a program that is mandatory and run by the state and so on and so forth. That one might, rise to the level of an actual tax, but otherwise I don't think workers comp qualifies. But again,
I don't think so either.
To a whole lot of interpretation.
Okay. And does compensating employees for personal cell phone use count? Great
question. I hadn't thought about it. It's either going to fit into the payroll bucket or into the utility bucket, and I don't have an immediate answer as to which one. Brent?
I can give you a best guess. If it's something that a company routinely reimburses people for their cell phone expense, telephone, for the PPP, telephone is listed. Doesn't say it has to be a landline hardwire. So okay. That's one where I would be inclined to err on the side of including it and see what your bank says.
If payroll is restored by June 30, proportional reduction is waived. Do you still need to have used the payroll portion of PPP within 8 weeks?
Yes. Yeah. So you're if you had originally assumed, when you did your loan, it's basically 2.5 months of payroll. And if we, do go back to that simple example there, roughly $750,000 of, or excuse me, $400 a month. So two months roughly would have been $800,000 of payroll. Well, if after work first wasn't working because they couldn't for various different reasons, you're only going to have $400,000 of payroll, during that period. And so your total forgiveness is obviously going to be less. You just won't have to go through that second reduction associated with the proportional adjustments.
Okay. We're just about in the last few minutes that we're going into an hour and a half. And so we've proven, I think, what I've heard about Zoom meetings taking about 50% longer than planned them to be. And before folks sign off, I did want people to check out the chat function here. And we've got a link on here. We're hoping that you might take the next few minutes to complete I think a 4-question evaluation. So that link is right in there, and you can click on it. Last question here. So one for a little bit more clarification. There's been a question around employee quitting before the 8-week period. Then will we be expected to pay back the difference of what their wages would have been? For example, does the loan forgiveness get reduced by the amount we would have paid them? Or if they're no longer counted, it's another situation. So maybe that first part of the question, does that have additional clarification to provide to it?
So the reduction, if they're not there to pay, then you're not going to get forgiveness on what you didn't pay. So I think let's just start there and make that simple assumption. If you didn't pay it, you're not going to get forgiven. So it just automatically converts to a loan, and you can pay that loan as quickly as you want to. But it's at 1%, generally a favorable rate, and you got 2 years total to pay it. So that being said, if they're not there, you're not going to get forgiveness. If they're not there for the specified reasons of they didn't want to take their job back because they liked unemployment better, you fired them for cause, etc., they won't count towards your head count reduction or your full-time equivalent reduction calculation. I guess the other thing that I don't think we mentioned too well is that in order to qualify for that safe harbor where you hire people back by June 30th, you had to have seen a payroll full-time equivalent reduction between February 15th and April 26th, which is statutorily defined. So you kind of look at what was your FTEs on February 15th. Did it decrease during that period of February 15th through April 26th? If it did, then you can get eligible for that safe harbor. And in order to get the safe harbor, you actually have to get your FTE count back up by June 30th.
Thank you very much. Go ahead, Brent. Yes, please, go ahead.
Yeah, I was just going to say, Eric is, absolutely right. If you can't get forgiveness on amounts you didn't pay. So if somebody quits like that, you wouldn't be able to get forgiveness on that. However, in terms of making sure that you don't get into that FTE reduction, remember one of the rules is that if you offer somebody their job back and they decline it, it doesn't count as a reduction in that FTE count. So quite frankly, I'll tell you what I would do if somebody quit. The first thing I would do is offer them their job back. And if they declined, you then make a note, I offered them their job back, they declined. And that's what I would do.
Thank you very much, partners, Moss Adams and Morrison and Company, for your time today. We'll see about getting the last 10 questions. We got 20 questions responded to. Last 10, we'll see if we can get an email response for folks. Thank you very much.
Thank you all.
Bye.